All right. Hello, everyone, and welcome to our Three Paths to Going Public event. I'm Ajay Vashee, a general partner at IVP and the former CFO of Dropbox, and I'll be moderating our discussion today. And I'm joined by the incredible CFOs of three IVP portfolio companies, Alicia Haas, CFO of Coinbase, Bert Podbear, CFO of CrowdStrike, and Spencer Lee, CFO of Hims & Hers. Each followed a unique path to the public markets, and I know we're all excited to hear their perspectives and grateful that they've taken the time to join us today. And thank you to all of our attendees for tuning in, and welcome to everyone joining us virtually from all around the world. To ask a question during today's discussion, please use the stage Q&A feature on the right side of the screen. The moderator will review submitted questions throughout the event, and we'll do our best to answer as many of them as we can towards the end of our time together. Before we get started, I want to pass it over to our event co-sponsor, Jeff Thomas, SVP and Head of Capital Markets at NASDAQ, to share a few words and provide some perspectives on the current market environment. Over to you, Jeff.
Thanks, Ajay. Hi, everybody. I'm Jeff Thomas, SVP here at NASDAQ, heading up the West Coast. At NASDAQ, we support companies at every stage of their journey. So we help early stage startups through the Entrepreneurial Center with free education and guidance. We help companies provide liquidity before an IPO through NASDAQ Private Market. We, of course, love to welcome companies to the public markets through any of these three paths, an IPO, SPAC business combination, or a direct listing. And then we support public companies through our investor relations, governance, and increasingly importantly, ESG solutions to help them be great public companies. What I wanted to do today was share a little bit of the current landscape of the public markets, show some of the relevant statistics around these different paths to the public markets, and share a few quick trends on what we're seeing on each of those different paths. So I'll go ahead and share some slides with you that we prepared. I promise it'll be quick and we'll get you right to the content that you're all waiting to see. So when companies are seeking to go public, there's really four key outcomes that they are striving for. One traditional role has been to raise capital. However, given the prevalence of the private capital markets over the past few years, we've started to see more and more companies able to raise lots of capital in the private markets. So while many companies look to raise capital through a public listing, that's not always the case now. All companies are seeking to provide liquidity. So as we mentioned, there is the ability to provide liquidity as a private company now through platforms like NASDAQ Private Market. However, to achieve the greatest level of liquidity for your employees, your investors, and your management teams, the public markets really are the ultimate path. One of the other considerations is as you're looking to build your business, if you want to do acquisitions, it's much easier to do them as a public company since you have a liquid acquisition currency that allows you to go out with a currency besides cash to go out and do acquisitions. And then last, and we think importantly here at NASDAQ, going public is a great moment to amplify your brand, not only for your company, but also for your industry, for emerging spaces like crypto. We think that was one of the really exciting things that Coinbase did was use their public listing as a really a great moment for the crypto industry. And so being a publicly listed company gives you a lot of stature and transparency. And so if you're in an enterprise technology business like Bert is at CrowdStrike, having a publicly listed financial statements gives those large enterprise customers more confidence that you'll be around for years to come and really partner with you as your customer. And then, of course, for consumer businesses like Hims & Hers, it's a great moment to attract new customers, raise awareness through a big stage. So, as we kind of look at what's happened over the last few years, in the light blue line here, you can see the number of operating company IPOs. And what you can see is that we've had a really healthy pipeline over the last few years here in the US, where we've been welcoming somewhere between 180 and 220 companies to market every year. Now, we're only 5.5 months through the year, and we've already welcomed 163 this year. Now, it's anybody's guess if this continues through the back half of the year, but we expect to see a much larger number of new listings of operating companies this year than we've seen even last year, which was incredibly busy as companies really got their legs under them once we got into the heart of the pandemic and companies figured out they could do virtual roadshows to go public. In the dark blue line, you can see the number of SPAC IPOs, or special purpose acquisition companies, coming to market over the past few years. And what you can see is that number has absolutely exploded. So we thought last year was amazing at 248, and this year we've already seen 330. I should point out that we actually saw almost 300 of those in Q1. So what you can tell us, we saw a big slowdown in Q2. And I'll get into why that happened on the next slide. And then what you can see in the orange bar is the number of SPAC business combinations. So as you can imagine, with more SPACs coming to market, we've been seeing more and more business combinations. We had 64 all of last year. That's when a private company merges with a SPAC to become a publicly listed company. We've had 40 through the first 5 months of this year, and we have a large number of announced deals that we expect to see coming to market over the balance of the year. Finally, in that barely visible green line, you can see the number of direct listings. And so that is an area that is increasing in popularity and discussion, especially amongst tech companies out here in Silicon Valley that have raised a lot of capital in the private markets and are not looking to raise capital currently through the direct listing, although we'll talk about that possibility here on the next slide. So what's going on with each of the paths to public markets? For the traditional IPO, as you've seen, it's still the dominant way that companies come to market. But with the different alternatives out there and options for companies, we've seen the banks getting a lot more flexible on two key areas. One, how they're pricing an IPO. And second, some of the restrictions around the lockup provision. So in terms of pricing the IPO, the banks are getting increasingly creative. They see the way that the auction dynamic of a direct listing works. And they're saying, boy, how can we adjust that and adapt that to our offering process and how we set the price for an IPO? Now, they still remain in control in terms of the allocations, but we are seeing some banks kind of take new creative approaches to how they're pricing the IPO and kind of setting that minimum price that people are going to come in at. And then around the lockup, you're really starting to see companies saying, look, we don't want to just have a traditional 180-day lockup. We want to potentially provide more secondary liquidity into the offering. We maybe want to set price hurdles where once the stock gets to a certain level, that releases some additional shares and kind of let those shares come out into market in a little bit more orderly fashion than letting everybody start selling on day 181. On the SPAC business combinations, as we discussed, there's over 400 SPACs that are out there actively looking for targets. And so I'm sure lots of the companies that are online today are getting daily and weekly calls from SPAC sponsors about a possible merger. However, we did see a couple months ago, the SEC issue some new guidance on how to account for warrants in SPACs. And that had a really chilling effect on the SPAC IPO market, as well as on the SPAC business combination process, as everybody had to go back, restate their financials, and really look at how they were going to analyze that going forward. And we're now seeing this really interesting discussion about how many SPACs are going to come to market with warrants or without them. We also saw some folks, some Congress people, put forward some proposed legislation that would eliminate the ability for SPAC business combinations to share forward-looking statements under a safe harbor. Now, that legislation has not moved forward yet. It's still just in the proposed state, but it's definitely an area that both Congress and the SEC are looking at, and we may see greater regulations around that. Finally, on direct listings, we did have a rule approved by the SEC that allows companies to raise capital through a direct listing. The current approved rule allows companies to raise capital within the stated range on the registration statement. We at NASDAQ thought that that might be a little bit limiting since many companies are going to want to go out and let the market determine the price. So what we did was update a new rule filing to ask the SEC for the ability to price a direct listing with a capital raise 20% below the range and with no cap on the upside. We're still working through the approval process with the SEC, but we think that that's really more of a market-based alternative. Frankly, we haven't seen a lot of demand from companies in terms of going to market to raise capital through a direct listing if it has to be through that limit order or within that range. So I hope that was a helpful recap of why companies are coming to market, some of the trends we've seen in the data, and some of the key factors that are weighing into each of these three pathways. Back to you, Ajay.
All right, that was great context. Thank you, Jeff. And Alicia, Spencer, Bert, it's great to have you all here today. I thought we could kick things off with a brief personal and professional check-in. And it's incredible that we're now 15 months into the pandemic. I'd love to hear how life has been for each of you over the past year, both personally and professionally. And I'm happy to start. Personally, my wife and I welcomed our second daughter, Annika, a few months before the pandemic started. And that's absolutely been a blessing. Has also been, I would say, both a rewarding and challenging experience raising her in a relatively isolated setting. And professionally, I made a career transition a few months ago, passing the reins as CFO of Dropbox to my successor and taking on a new role as a growth stage investor with IVP. IVP helped to lead our Series B at Dropbox and is a fund that I know has been a close partner to each of you and your companies through your respective growth journeys. So Spencer, why don't I turn things over to you next?
Sure. First, really appreciate you asking this question. I personally count myself pretty lucky. Our immediate family has stayed pretty safe and is in good health throughout. Hims continued to do well as a business, and we went public. So really can't ask much more than that.
Awesome. Alicia, I'd love to hear from you as well.
No, happy to share. So I'll start with the personal side. So we took the opportunity of COVID to relocate to a small beach town. And this is after 20 years of my family and I living in New York, Chicago, LA. And so we are now embracing gardening and really the lack of anonymity that comes with a really small town. And on the professional side, Coinbase has been moving in all directions. So we decided to go public. So we did that. But we also decided to become a remote first company and double in size. And so we now have an employee base spanning the country that over 60% have joined since COVID that I've never had the opportunity to meet in person. And that's provided a lot of opportunity and challenge to just operate a company with so many new folks who you haven't had the opportunity to actually meet. And so it's a new way of working that we're learning how to embrace.
Totally. And Bert, how has the past year been for you?
Thanks, Ajay. First, it's great to be here and great to be on this panel with Alicia and Spencer. On the personal side, the one silver lining for COVID for us was my older daughter. With her job not the office being closed, she's at home with us. So I got that additional benefit to spend some additional time with my elder daughter. It's been fantastic. On the professional side, many of you have seen in the news what's been happening with ransomware attacks and cybercrime. It's another explosion in that space, in our space, and we're doing more media, more discussions, more panels like this because now cybersecurity is just a need to have. What company is not going to go spend some money on cybersecurity? Everyone is, right? So it's been quite busy, and really trying to lean in and trying to help where I can for companies that have us and continue to ward off the bad guys, and also the companies that don't have us yet, trying to tell everybody about the benefits of having us and the price of getting breached.
Totally. I could not agree more. And thank you all for sharing those perspectives. I'd love to spend a moment on the concept of a return to work. And as vaccination rates rise, many companies in our portfolio are debating if and how to resume in-person work and collaboration. I'd love to hear about whether you're considering hybrid or remote or in-person model for your organizations going forward. And Alicia, perhaps we can start with you on this question. Coinbase announced that they plan to embrace a remote first philosophy. Can you help explain what this means?
Absolutely. So yes, we are remote first, which really comes down to employee choice. Employees can choose whether they want to be in the office full time, whether they want to be hybrid, or whether they want to be fully remote. And interestingly enough, we have now more than 40% of our employees who are living in a non-commutable location. So 40% at least have chosen to be 100% remote. And then the balance, the 60%, have the opportunity to be hybrid or in the office. When we do surveys of employees, a very small percentage plan to be in the office full time, and we expect to be largely hybrid and remote.
Got it. Fascinating. And Bert, how is the team at CrowdStrike planning to return to work?
Yeah, so first I'll preface it by saying that prior to the pandemic, we were 70% work from anywhere to begin with. So it hasn't been a big transition during COVID, and then post-COVID, because we do have some offices, it's similar to Alicia. It's a choice. We're not it's going to be based on need and local law, right? Those are the things that we're doing. So, we're allowing people to come back to offices, in the near term. We're still figuring out all the rules and everything else for each site before we open up a site. And so, but that's on the plan for the summer to kind of basically do a hybrid model. Going forward.
Got it. And Spencer, how are you thinking about reconstitution at Hims and Hers?
Yeah, we went full remote last spring and are fully committed to it. We've hired senior leadership in New Hampshire, Maryland, LA. So at this point, we're pretty all in on remote. The one thing we're thinking through is, with all the money we're now saving on rent, is how to potentially redeploy that capital to opening up travel budgets where teams can at least still get together offsite on a periodic basis. And that's kind of the thing we're actively working through right now.
Thank you for that perspective. And I would say, moving on to our next question, our panel today is titled 3 Paths to Going Public. And our goal is really to share some perspective with the hundreds of viewers that are tuning in on what the process of navigating a transition to the public markets was like for each of you. And I'd love to hear about your individual journeys, from making a decision to consider a public listing, to managing readiness efforts, to deciding between an IPO, a direct listing, or a SPAC. And perhaps we can start with the first stage of the process, deciding when it was the right time to consider a public listing. What were the variables that played into that decision and calculus for each of you? And Bert, maybe maybe you can help kick things off for us here.
Yeah, for sure. So, Jeff walked through all the reasons to go public in any shape or form. For us, the big one was brand awareness, right? Back in the day, there were a lot of big competitors out there who had, done well in cybersecurity, but we thought that, we had a different approach to cybersecurity, one that we felt would be much more effective. And so branding was huge. We were not known in all 4 corners of the globe at all. And so we were trying to, bring out that awareness. Becoming a public company was definitely on the path the whole time. We did all the things that you would expect that one would do, talking to, buy side, sell side, all the time, getting their perspectives as well as we went down the path of, going to choose a public path. We didn't consider SPACs. It wasn't really in vogue at the time, and nor did it ever really reach the board level. Direct listing did a little bit, but it quickly went by the wayside. We saw all the reasons that Jeff put up there to go public in the traditional sense, but more importantly, we felt that the idea of leveraging the bankers and their networks to continue to spread the gospel about CrowdStrike was important, and so that was a big reason why we went to the traditional path.
Great. Very helpful context. And I want to spend some more time over the next couple of questions on readiness efforts and deciding between the paths. But before we get there, Spencer, I would love to hear your thoughts as well. When was it the right time for Hims and Hers to consider going public?
Yeah, so Hims launched in 2017. And like most young companies, the story around our market and our opportunity have always been clear, but the financial story was evolving. And by early 2020, the financial story rapidly started to take shape. Our growth visibility, margin profile, unit economics, even path to profitability all began to really take form, which at that point gave us the confidence to really start thinking about going public.
Got it. Makes a lot of sense. And Alicia, what really played into Coinbase's decision to consider going public?
So much like Bert and Spencer shared, there's many different factors, but for us, it was a lot where the industry of crypto had matured to. And so we felt not only were we taking Coinbase public, but we were introducing the entire crypto economy and just crypto in general to a much broader group of investors. And we felt that we needed to have that level of maturity, that level of just growth in developers, in apps and assets, in awareness, get to a point before Coinbase was ready to go public. And so in addition to our own financial state, in addition to our management, our controls, and our public company readiness, we look to the industry as well.
Got it. That makes sense. Moving on to readiness efforts, I'm sure that everyone considering a public listing would be curious to hear what the most important pillars of that process were for each of you. How far ahead of a public listing did you kick off your internal readiness efforts, and what required the most work, perhaps? At Dropbox, I stepped into the CFO role about a year before we got on file with the SEC to go public. And for me, my initial priority was hiring a strong and experienced team around me. So I hired a chief accounting officer, a VP of FP&A, and a VP of corporate finance and strategy. Each had worked through the IPO process multiple times. We also kicked off an ERP transition, like I'm sure many of you had to, from NetSuite onto Oracle Fusion. And we spent a lot of time refining our forecasting muscle by running mock earnings calls with the crossover investors on our cap table. But curious to hear the process each of you worked through. Spencer, maybe we can start with you. What was the readiness process like at HIMSS, and were there any key hires or initiatives that stood out as critical?
Yeah, so I'd say our process was maybe a little unique. It was a bit of a sprint. So I joined in early 2019, and roughly 12 months later, we were starting the path of looking at traditional IPO path and or SPAC path. So it was really from day one to 12 months out, putting the pieces in place sort of the moment I took the seat, from a hiring perspective, from a systems perspective, and really building day one towards that outcome. I mean, similar to what you mentioned in terms of really finding the right team with the set of experiences that you can surround yourself to really scale and build to be public ready. A lot of hiring was key. I'd say for the going public process itself, the thing I'd add, especially for the SPAC process, is that finding great advisors and consultants was just as critical. We had outside help for technical accounting, SOX, going through an SEC pre-clearance process, tax systems, and maybe just as important as all of those, recruiting agencies to help build the team. I think as CFOs, we often can be penny wise, but given the timing pressure and unique reporting requirements of a SPAC, we moved pretty quickly to identify advisors with the exact experience we needed and moved quickly to engage them. So, in a SPAC process, and again, given the specific timing pressure around it, it's not exactly a situation to optimize for the lowest cost provider.
That makes a lot of sense. And Alicia, what about you? How did the readiness process work at Coinbase?
So it's interesting because Coinbase licenses required us to have controls opinions on our financials. As an example, we had built the books and records infrastructure, the data infrastructure, long before we made the decision to go public. And so when we decided to go public, the missing pieces for us were more around the IR function, the building out the marketing team so we could really maximize the brand awareness around a public listing. And it was less so on being able to close the books, issue Qs, issue Ks, that we actually had really good muscle around. So when I looked back at the process, the things that I think were so critical to just have in place were that accounting team with the clean books and records and controls. One of our best decisions was we actually pursued private letter rulings in advance of the decision to go public so that we had confidence in our accounting treatment, which especially because crypto is a new asset class with new accounting issues, we didn't have any comps or anything to go on. And so getting that out of the way before we were just in the sprint to go public was really helpful. But for us, the forcing function, what was really helpful was aligning the exec team on the narrative. What are the key messages that we want to be able to message to investors? What is our story? Because it is so new and complex, we wanted to make sure that was really well understood by the market. And so drilling on that narrative, drilling on our KPIs, making sure that we all were focused on the right North Stars was one of the things that we really put a lot of time and effort into as a team. And then last, my best advice is you really need to align on your first principles. Why are you going public? What are the goals? And making sure that everyone has really clear on what those are before you make the decision on the structure of how you actually get public, because as we're going to talk about, there's a lot of different choices. And so whenever questions come up later down, you can go back to those first principles and say, why are we doing this again? What is important to us as a team?
I think that's a great point. And on the topic of narrative, how did you, one quick follow-up question for you before we move on to Bert, how did you manage the development of that narrative heading into your direct listing? Was that something that you and the IR team largely owned? Was it something that you developed in close partnership with the marketing and comms team? How did that process work?
It's a great question. So we did a private company investor day to have a practice round of what is our narrative before we were drafting an S1, making a decision to go public, which was really helpful to us. So we got investor feedback, but it was a combination of a lot of folks. It was folks on our strategy team. It was folks in the finance team. We didn't have an IR team at the time, and we didn't have a marketing team at the time. So it was really pulling together what we had to really drive that story with the exec team's input.
Got it. And Bert, I would love to hear your thoughts as well, the readiness process and what it entailed at CrowdStrike.
Yeah, I could spend 3 days on this topic, but I'll really bring it down. So basically, I started in 2015. We went public in 19. In 15, like probably many people who are on here today, we were a small company. We're about 21 million in ARR. For context, we're now just under 1.2 billion. So we knew we wanted to have a path to high growth. So number one, what I did when I came on board, I knew there were likely two possible outcomes for this company. One was an IPO, one was a sale. And the process for a while is the same. And then there's obviously a divergence when you get closer. So number one was, to your point, Ajay, is the team. I went with we head of FP&A, head of accounting, and then head of Wall Street, also strategic finance, so that I had all three kind of bases covered. Then really gelled and learned more about the CEO. So for the first year, or even a half a year, really went to every single conference that we could, and I did more of the listening, right, to the CEO, his message, his narrative, kind of things that Alicia was talking about, making sure everybody was on the same page. But I needed to be on the same page with the CEO, 100%. And I had never worked with him before. I knew of him, but I never really worked with him before. So it was really getting that cadence between the CFO and CEO. And then, after that first year or first 6 months, it was just pounding the pavement and talking to sell side and buy side every single week, every single month, every single quarter, right? Getting the feedback, getting the understanding. A lot on the buy side, and to Spencer's point, making sure you had that right amount of leverage in your P&L, your gross margin profile was working, all the unit economics were in shape. Now, they didn't have to be perfect, right? You wanted to have room once you're post-public to kind of go into where you wanted to go. So that's part of that whole kind of dynamic. And then when we got to where, we knew we were about a year out from a prior company, I had a nice little checklist, right? Not one of these 18 pagers, right, that the lawyers and the bankers will provide you, but I had one that was basically 2 pages. And it was basically things like, your IT systems, or you're able to forecast 3 quarters in a row within a range, right? And to make sure that you're going to hit your targets. And then, from there, you had your checklist. It was you went through it. It went through all the different bits and pieces, making sure the right consultants, whether it's IR, your bankers, your banker lineup, how you were going to think about. We made the decision we were going to go public, the traditional path at that point, and not go through a direct listing or a SPAC. And so then it was all about, okay, how is this process going to go, right? Who are going to be my advisors to help me through it? And so we reached out to, a few of our investors, our early investors. They had some really experienced people on the capital market side. And so, like IVP and others, they all tout out how we could be value add, right? Well, let me tell you, these folks were real value add, because, dealing with the bankers and economics and who's where and all that stuff can get kind of messy. Certainly, you wanted to keep good relations with your bankers and your consultants, and that's where those folks came in. Really helpful during that process, which is about 6 months. To make sure that all gets tick and tied, and then going public, you press the button, and okay, now we got to make sure we are able to close the books on time, all that kind of good stuff, and continue to hit our mark, and that all kind of lined up well before we went public. But as we were public, we kind of knew within a range kind of how it all was going to work from a numbers perspective, and then flighting all the different groups together, like Alicia was talking about. So everybody was on the same page on the narrative. Everybody was on the same page of how we're going to market. Everybody was on the same page of the roadmap, so that there were no wobbles, right? And knock wood, we've had a pretty good run 2 years post-public with hitting our mark. So in a nutshell, that's kind of how it all unfolded, and hopefully that was a little helpful.
Awesome perspective, and the value add that you're describing, I would say is exactly the kind of perspective that we're hoping to bring to everyone that's tuned in today, both in our portfolio and companies that may not be part of it. But let's transition to the unique path that each of you chose to transition to the public markets. And Alicia, you chose to pursue a direct listing, Bert, a traditional IPO, and Spencer, a SPAC combination. When I helped take Dropbox public in March of 2018, there was really only one mainstream option at the time, and that was an IPO. But today there are clearly a handful. Alicia, maybe we can start with you and understand what played into your decision to pursue a direct listing. Did you consider an IPO or a SPAC, and what were some of the trade-offs that you thought through? And how did your board and executive team go about actually making the decision?
Absolutely. So I think it's really important that I start off with everyone understanding that you can easily switch from a direct listing to an IPO, but there's challenges of going from an IPO to a direct listing. So when in doubt, file your initial S1 as a direct listing, because you always have the option to, even like a month before you go public, to be like, okay, I'm doing an IPO. So a direct listing, in our view, provided option value, and we were not closing any doors. But at Coinbase, we started with those business objectives that I alluded to earlier. And then once we had aligned on our business objectives, we focused on which of the paths and structures best met those objectives. So our primary goals were liquidity, and then brand awareness, or the way that we spoke about it internally, which is to bring more transparency to crypto. And any of the three paths could have achieved those two primary objectives. And so then we looked at secondary objectives. And then we really got closer to who we were as a company. And our mission is really important to us. And our mission was creating an open financial system. And our second important objective was to minimize dilution. And we believed that we were going to be a hard to value company. I've said before, we're the first crypto company. There's no natural comps for peers to look at. And therefore, we thought there would be a divergent view of value. And so when we then looked at those two facts, like what would be closest to building an open financial system and what would be the lowest dilution, since we were unclear about how it would be valued, it was very clear that a direct listing was the optimal structure for us.
Perfect. And can you walk us through, Alicia, some of the mechanics of a direct listing? How does the process work, and what are some of the major milestones as you get ready to flip the switch?
Sure. So it looks very, very, very much like a modified IPO in many respects. You file an initial S1. The key differences are that your financial advisors are truly just financial advisors. They're not underwriting an offering, and therefore they're just advising you, the management team. You, the company, are doing all the work. So what that means, you're reaching out to potential investors, you're setting up test the water meetings, you're setting up roadshow meetings, you're deciding on how to bring this company to the market. The financial advisors are the ones advising NASDAQ or NYSE on, yes, you can open the market, but they're providing really no connective tissue to the investment community. That is 100% on the company. But the process of doing the S1, drafting your financials, telling your story, it is identical to an IPO process. And so the other thing that I would just point out that is like super, super tricky is the stock administration process. So all of your existing shareholders are selling their shares, and that includes your employees, potentially your thousands of employees. And as you just saw when Jeff Thomas produced the slide, there's been a handful of direct listings. So typically it is the very first direct listing that your investors and employees are going through. They haven't been through 3 other startup companies that have done an IPO. They're doing their first direct listing. And there's no lockups, as we've talked about in a direct listing, where there has been one, Palantir did lockups, but you have the ability to do no lockup. So now you have thousands of people who are like ready to sell their shares on day one, and getting those shares broker ready to be able to transact in the opening order is complex. These are archaic rules to delegend shares, to move them to executing brokers. And that process is 10x more work than an IPO. And so you need to put a lot of effort, get the right advisors. There's amazing stockholder counsel out there who can guide companies through this, but that takes time. That takes a lot of employee education and white glove service to get right. And that it's the meeting with investors and then the stock admin that I think of the two really material differences, outside of then just the fact that a direct listing is market-based pricing and allocation, and an IPO is company-based pricing allocation. But mechanically then I think they're very similar.
Got it. That's fascinating inside knowledge of the process. And as it relates to taking that investor relations burden on through the process of a direct listing, how important was it to have a team that had the right connective tissue, that had the right experience, that had the right public market relationships as you navigated that process?
I am ever so grateful for my IR leader and my IR team. They were very experienced. They had deep relationships with many of the investors that we wanted to reach out to. But I think it also depends on who you are and what company. We were also really lucky with Coinbase that we are a market leader in crypto. I think crypto was having a moment when we went public where it was in the headlines every day. And so I viewed that there were folks that were crypto curious where even where they may not be ready to invest, they definitely wanted to learn more about our story and were eager to take a call and to meet with the management team. So I think that there was a combination of, yes, we had a wonderful internal team who knew the right portfolio managers and folks for us to reach out to, but two, our company and the time and place that we were going public meant that people were really interested in learning who we were and what our story was.
Got it. And Bert, what about you? Why did you decide to pursue a traditional IPO? And can you walk us through some of the mechanics of a traditional IPO process for those on today's call that might be less familiar?
Yeah, sure. So to be completely frank, the decision to go IPO, traditional path to IPO, was really always on the table. We really didn't really talk about it, direct listing. I'll tell you why in a minute. SPAC, as I said, in 19, it wasn't really in vogue. It really wasn't, on the table. With respect to the traditional IPO versus the direct listing for us, and the reason we went the traditional path is, why did we go public? So one, it was, liquidity for sure. Branding, as I mentioned, is probably the number one thing. We wanted to get out there. There were big incumbents. We wanted to get out there and say, hey, look, we're the only pure cloud delivered security company out there and all the benefits, right? Efficacy, of course, being number one, but then you've got, total cost of ownership being two. We were consolidators, so we were really, helping companies reduce their spend in cyber. And then three, time to value. Through the cloud, you're able to deliver this stuff in seconds, right? And so we wanted to get those messages out there, and the traditional IPO allowed us to not only do it ourselves, and all the things that Alicia talked about internally about what she had to do in her teams, but also, leveraging that whole network from, all your advisors and the bankers and everybody else, spreading the gospel, right? Big megaphone, lots of interaction, between, high levels of each of the banks that we're dealing with, the bulge, the left, the non-bulge, everybody was talking about us, right? And that was kind of the fervor we want to generate. In terms of the process, like Alicia said, that very similar in terms of, getting the S1 ready, doing all the things you need to do with sell side and buy side. One little thing, though, one difference that was out there for us, and a thought for anybody kind of thinking about, direct listing versus a traditional IPO. When you're thinking about pricing, the company decides for a traditional IPO, not the market. And there are going to be people who want to, price perfection, not leave a penny on the table, right? And that's the direct listing for sure. For us, I didn't, necessarily, want to do that as a public company CFO. At the end of the day, we set the pricing, and there's no harm from my perspective at the time, in leaving some money on the table for the buy side, right? So they come in at the IPO, it shoots up, great. They make their, maybe there's a target in somebody's mind that you want the buy side to make, whether it's 20%, 30, 25, whatever it is, 15, because you're going to need those investors later on. We've been out 2 years, and some people who were in the IPO, they were in the IPO. We had our stock shot up day one, and some people sold, but then they came back, right? And that's something that you don't want to lose sight on. And so that was a big discussion, certainly at the board level, at the pricing, the day before we priced. What number did we pick? And it was okay. No, it was a healthy argument. Let me be completely frank. There were people in that room who were like, we went at 34. You could go as high as 60, right? And we said, no, that's probably not the right answer for us. Ultimately, we wanted to make sure that when we priced, that was the lowest price that we'd ever see in our stock in our history. That's what we were shooting for. Obviously a black swan came in, and we got hit. We were a little lower than our IPO price for just a little bit of time back in March of last year. But other than that, not so much. So that was really important to us as we thought about the traditional path versus direct listing.
Amazing. And Spencer, how did you make the decision to go public through a SPAC? And can you walk us through some of the mechanics of how a SPAC combination actually works?
Sure thing. Yeah, so we wanted to raise primary capital. So really it was just a decision between a traditional IPO and a SPAC. And as we evaluated the two choices, I think the three things that stood out that we really valued with the SPAC were certainty, timing, and flexibility. And so the primary difference between, and benefit maybe, I point out between a SPAC among these three options is that the SPAC is uniquely a principal-to-principal set of negotiations. It's a direct negotiation with the SPAC sponsor and then a direct set of conversations with PIPE investors. All the important terms are negotiated and understood upfront, including valuation, fees, structure. All of this is negotiated upfront by management. There's no broker or bank sitting in between, holding all the key information, trying to make a market at the very end. And in this way, it's a more straightforward and streamlined process than, say, a traditional IPO. An example of the unique flexibility with SPACs, our board was really sensitive to dilution, given how early we were still as a company. So we were maybe one of the first companies to negotiate an earnout structure in our deal, where after going public, if the stock traded up to certain price levels, existing shareholders would receive additional common shares. And so to date, after going public, we've hit all of our price targets and have delivered on all these anti-dilutive measures for our investors and for employees. So it was a really great benefit that we were able to negotiate this in and put something like that in place.
Fantastic. Yes. Thank you for sharing that. And moving on to our next question, the media and markets tend, I would say, to be fixated, arguably overly fixated on short-term share price performance after a public listing. And how did each of you define and measure success internally? Do you think that you had a successful public debut? Bert, I'd love to start with your perspective.
Yeah, it's quite simple. Here's your initial price. Where did it go the next day, right? That's kind of like how you want to think about it in the very, very short term. But then, as I said, long term, we wanted to pick a stock price, an IPO price, which would be the low point in the history of the company at the IPO. And so that's kind of how we thought about it, and that's certainly been the case. So we think about the IPO as very successful, right? A lot of folks who were with us a long time, they had a great return on the investment. In us. And so, we think about that short-term, gainers, great. That was a success. And then midterm, what does that look like in the next year? And then longer term, are we consistently above, that IPO price? And, clearly we are. And so it's been great from the standpoint of having looked back and said, yeah, we kind of did all the things that we thought we needed to do spot on. And so we look back and our investors look back and say, that was a successful IPO.
Great. And Spencer, how about you?
Yeah, so I think, in terms of the valuation that we set, our philosophy was to set a fair valuation, right? For the company, for the existing shareholders, for our employees, and for people that would be investing in the SPAC and trying to strike a good balance. I think, the way we've really measured our success from the process is really, measured in the business performance, frankly. Since going out, we've put up 2 strong quarters that we've reported already. We've provided, reasonably strong guidance for our current quarter. So, our business performance, I think, reflects all the hard work that we did to get ready for being public. And I think that work to get ready to be able to put up sort of consistently strong performance on the business side, then reflects itself today where, the stock is traded up nicely, from, the starting SPAC price that we initially listed at.
Yeah, I think that's great perspective. And Alicia, how would you reflect on the success of your direct listing? I know it was very recent, so is it even too early to be asking the question?
Oh my goodness. Well, I think that we focus on the transaction itself. The transaction itself, we met all our goals. We got liquid, which was our goal. We did it in coordination with our mission, which was that we had an open transaction where anyone could submit an offer. We think about ourselves as a long-term investment. We're in a volatile market. Crypto is very volatile, and we expected volatility in our stock price. And so yes, our stock price has bounced around a lot, but that was not outside of our expectations. And so we don't look at short-term performance as an indicator of success, but we really focused instead on, was our message understood? When we read research reports, do the analysts understand the key narratives? Do they understand our company? And then investors similarly, do they understand our company? And then lastly, we focused on what was our investor and employee experience, as there has been some bumps in the road with past direct listings that employees couldn't actually sell on day one. And we wanted to ensure that we learned from the past and that stock administration that I shared with you. And we had a very positive experience there. And so from those metrics, we think it was a success.
Great, great. And we have a lot of finance executives in our audience today who I'm sure would appreciate being able to see around some corners, knowing what you all know now, having been through the recent processes that you all navigated your companies through, as it relates to things like internal readiness and the process of going public. Is there anything you would have done differently? Would you choose the same path again if you had to do things over? And Alicia, maybe we can start with you and then move on to Spencer and Bert.
If my goals were the same, I would absolutely choose the same path. So I think it comes back to your business objectives time and time again. The other thing I would just share is we were able to raise a convert about a month after going public, which then satisfied our need for capital at a very low cost of capital. And so that combination of transactions really met our goals even more, so that we didn't have much of a delay in our ability to access the capital markets. And once you're public, you just have so many more structures and so many more options for capital. And the things that I would have learned, that I learned along the way that I would have done differently, we were very reluctant to announce that we were going public. We tried to keep it very confidential, but in hindsight, I would have announced our intention the moment that we thought about it, because our speed of hiring just picked up tremendously. People want to join companies that are about to go public, and I think we would have benefited by that hiring acceleration for a longer period of time. The second thing is we opened up secondary trading in our stock for purposes of informing a reference price, and it ended up not being used. Trading was very thin. And this was a lot of extra work, and I wouldn't do it again. I would just let the reference price be the reference price, because it has no bearing on how the stock trades. And so we put a lot of work into something that was frankly quite not useful. And the last just point of information, it took a lot of time to get our IR site launched. It was literally 2 months from signing a contract to getting it launched. And so make sure that you plan extra time for that.
Amazing, amazing. And Spencer?
Yeah, I think given the things that we were solving for, again, timing, certainty, flexibility, the SPAC achieved and the transaction achieved, all the outcomes that we wanted. So no regrets, no changes. I mean, I think the two things that I would maybe point out for folks that are thinking about going down the path of a SPAC, just to consider. I think first thing is, unlike a traditional IPO, you don't get kind of the out-of-the-box sell-side research coverage that typically comes, with your underwriters as part of a traditional IPO. So to get reasonable or sufficient sell-side coverage out of the gate, that's just an extra consideration, extra work. To the extent that you engage an IR consultant, I'd put that high on the list of things to think about and strategically, try to achieve as part of the process. I'd say the second thing that's maybe unique to SPACs is the rotation out of the shareholder base rotation from the initial SPAC holders. So, as you reverse merge into the SPAC, the existing shareholders of the SPAC often are hedge funds or sort of not the typical long only type institutions that you would typically sell into a traditional IPO. So there will be almost certainly rotation in your shareholder base early on. And so, if you're a company that is not comfortable with or doesn't want a level of volatility that might happen as a result of that rotation, call it in the first 6, 9, 12 months of being public, that's probably just another thing to consider. But to the extent that you're long-term focused and focused on driving long-term value, that rotation is fairly short term and something that you'll get past in fairly short order.
Awesome. Thank you for sharing that. And Bert, is there anything you would have done differently in your process?
Yeah, it's a great question as I reflect back. I think we wouldn't have changed the path. You can see here all three of us have had success in terms of, what path we chose. With respect to the traditional path, the only thing I might have done different was we didn't go to Canada, right? We on our roadshow. It was like, we thought about it. I'm Canadian. I wanted to go and talk to some of those big funds, whether it be CPP or one of the provincial funds. We didn't do it. I did it on a phone call, and it kind of like I felt like I was not giving paying homage to my roots, right? That was the one thing that I would have probably done differently. And then what I would leave with everybody, if they do choose to go down the traditional IPO path, if you're a CFO or a CEO and you want to make sure that you have great success on the traditional path, make sure that you absolutely pound the pavement and hit the buy side lighting, no motion. You have what you want to make sure you do is you pound the pavement. You and your CEO are making sure that the buy side really gets comfortable with you prior to the roadshow, right? So you want to go to the roadshow, you're going to meet, 100 buy side folks. You want to walk in that room and you're just updating the buy side. It's not retelling the story, telling the story for the first time. What do you guys do exactly? If you have that question, you didn't do your homework, right? And so you want to really have massive breadth in terms of going out there. I had the luxury of being, private for years before we went public. So I knew really well the buy side and who was going to be on the roadshow. I think out of the 100 clients we saw, I knew 98 of them, right? And so that's something, and you do that through conferences and webinar, all the stuff that you would do. But you got to put in the time. And then when you're on the roadshow and you're pitching your stock, there's going to be this massive amount of efficiency, right? That's gained by doing that, and it makes it such a better discussion and better questions at the roadshow. And also in the stock performance, if you do all that homework beforehand. That's the biggest thing I would recommend to folks.
Great advice, and I'm going to jump in with a couple of questions that are being submitted by the folks that have tuned in, and then I have one final question to wrap things up in a few minutes as well. But switching over to audience Q&A, we have a question here for Coinbase and HIMS, companies with not as many comps as CrowdStrike in security SaaS. How did you decide on key metrics and KPIs to report in your S1? Maybe Alicia, we can start with you, and then Spencer, get your perspective as well.
The same ones we use to manage the business. So we have consistency of what we talk to our teams about, our board, our investors about, and we just focused on the most high-level metrics, so not subsidiary metrics, just the metrics that are the most important about driving our revenue and what we focus on to drive growth in our company.
Yeah, similar. I think fundamentally there's two things that every investor needs to be able to back into, and it's price and volume. And what are the two metrics that for you as a business, where you can derive those two things such that A times B effectively equals revenue. And we added the sort of additional layer of maybe a more leading indicator in terms of the number of subscriptions on our platform. That's not necessarily specifically tied to revenue in any period, but like Alicia mentioned, it's just the core metrics that truly underlie the performance of the business.
Yep, that makes a lot of sense. And one question for the three of you that came in from the audience as well. Is around how you resourced the readiness process internally, and what was the incremental headcount needed, not just in the finance organization, but across the company to be ready to go public. And so, where were, I guess, to rephrase the question a little bit, what were some of the areas and investments that you had to make across each of your companies to get public company ready? Maybe Bert, we can start with you here.
Yeah, clearly, obviously, the finance and accounting staff, you're tripling it, right? And don't skimp there, right? You don't want to be caught flat-footed. So make sure that you've got ample resources internally. Then I advise everybody to build out your IR team, hire an IR consulting firm. Just do those things, right? And then, throughout the other pieces of the organization, IT is a big one. Make sure that you're able to build out your IT team so it's scalable, so you don't have any issues with, onboarding and getting people ready, because you don't want this kind of chaos when you're just about to turn the corner and become public. Sales and engineering, with sales, obviously, you want to make sure that they have the right capacity planning for years to come. You're dovetailing that into the metrics that are important to you on unit economics. So you're making sure that everything ticks and ties well before you go out on the sales side. So you make sure you have the right sales ops team and leader, because there'll be a big piece of, or sales enablement, whatever you want to call it, making sure that they have that in place. And obviously on the engineering side, make sure if you're a tech company, make sure you never underinvest in, in innovation. You got to make sure that you continue to innovate. Don't get distracted by the public offering and everything else. Make sure you don't, skimp on that one either.
Great. Alicia?
I don't think I'm going to answer this question well, because as I mentioned, we had to have controls opinions on our audited financials prior to becoming a public company. And so our incremental resources just to be public were quite modest, all things considered. It was just a handful of folks in IR, financial reporting for the MD&A, and then our legal team for all of the plethora of SEC filings that one needs to make as a public company. So those were the three groups that we really augmented away from our business as usual roadmap.
Great. And Spencer?
Yeah, maybe just to add on to what Bert said, HR and legal are obviously areas that you need to be heavily invested in as well to be a successful public company. And I'd say maybe sitting in the finance seat, just having the mindset of actually encouraging all of the teams to actually hire aggressively and hire quickly. That's not often the message that the finance team is delivering to the company, but I think in every instance, right, across all of the departments, as we were moving down this path, I think all of us felt like we probably should have hired more, hired faster, hired more aggressively to make this process more streamlined, less painful, and more successful across the org.
Yep. And final question for me, we're almost at time before we wrap things up. What has life been like on the other side? How has life been as a public company CFO for each of you relative to being a private one? And what's been the biggest change? Spencer, maybe we can start with you and then move on to Bert and Alicia.
Yeah, I'd say it's been great so far. I think it's when you're maybe in the fortunate position of having been public for a few quarters and have had the privilege of delivering consistently good news, it makes life pretty easy as a public company CFO. I'd say the biggest change, definitely from a time and responsibility standpoint, has been on the IR side. Going from updating a handful of VCs, once every 3 months, versus the time commitment of, talking to buy side folks, existing investors, potential investors, keeping up with the sell side, and having to continue to communicate and keep the board up to date. It's a broader set of time commitments, and really having and surrounding yourself with the right team that can be high leverage to pick up the other elements, so that you can manage your time, accordingly with the additional IR responsibilities. That goes obviously a very long way.
Absolutely. Bert?
Yeah, the biggest one for me was the amount of time I spent obviously on Wall Street versus other things. And the other things for me was I went on the road a lot with the sales team, right? A lot of sales calls, understanding the customers, what they needed. As a CFO, you really want to understand the business. And so I would go all the time, on the road. The other thing is like Spencer and Alicia, I've been mostly a public company pandemic CFO, right? So the amount of time that Wall Street needs to be in person, that wasn't there, which was really helpful for me. I don't have to travel. Having said that, these Zoom calls and all the other types of conferences that we do virtually, went through the roof. So you got to kind of, have that slider to make sure that you keep everything in balance. But the biggest one was the amount of extra time with Wall Street, buy side, sell side, and certainly with the Zooms, it's made it a lot easier to to do more of that.
Totally. And I experienced the same thing at Dropbox. The amount of time that was spent on IR certainly increased multiple times from being private to being public. And Alicia, biggest changes for you so far?
I'm going to focus actually on the biggest change for our employees, which is that we had a culture of really a lot of transparency and sharing metrics. And we really had to pull back our access to data and educate the employees on what is MMPI, why is MMPI so harmful. And that has been a big cultural change for us about who has access to data, what people can talk about. Can they talk about it with their team? Can they share a big announcement on a product internally when we're in an open trading window? And we've had a lot of cultural change around that we've had to manage through carefully.
Totally. I think that's a great point. And that brings us to the close of our session today. Thank you all so much for sharing your incredibly valuable perspectives. And thank you to everyone that's tuned in. I had an absolute blast moderating today, and hopefully we can do something similar again soon. So thank you.
Thanks, Ajay. Thanks, everybody. Bye for now.
Bye.